Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to show you how to do stock valuation. Valuation is a process by which an investor uses risk and return concepts to determine the worth of a security. In other words, this is to calculate the real value or real worth of a common stock. Such real value is called intrinsic value, whereas the market value is determined by the demand and supply of common stock in the market. In making an investment decision, the investor would decide if a stock is undervalued or overvalued by comparing the current market price of the stock to its intrinsic value. As a simple principle, if the intrinsic value is greater than the market value, then this common stock is undervalued. So, it could be identified as a worthwhile investment candidate. If the intrinsic value is smaller than the market value, then the stock is overvalued. So, it is not a worthwhile investment. However, if the intrinsic value is the same as the market value, the stock is fairly valued. Of course, there is no assurance that actual outcome will match expected outcome. Intrinsic value is also called justified price or expected price. Before calculating the intrinsic value, you will have to know how to calculate the required rate of return, in short, required return. Required return is the return necessary to compensate an investor for the risk involved in an investment. We could say that it is the lowest acceptable return for investors. Usually, required return is used as a target return to compare to the forecasted returns on potential investment candidates. To calculate required return, we take risk-free rate plus market return minus risk-free rate times stocks beta. For that, risk-free rate is the rate of return of an investment with zero risk, usually represented by return of treasury bill. Market return is the rate of return based on market index, whilst stocks beta measures the market risk of an investment. Let's take an example. Assume a company has a beta of 1.30, the risk-free rate is 5.5%, and the expected market return is 15%. What is the required rate of return for this investment? By putting all the figures into the formula, in which risk-free rate 5.5%, beta 1.30, and market return 15%, you will get a required return of 17.85%. This is the lowest acceptable return of this investment. The actual return is supposed to be higher than required return. Now, let's try to calculate the intrinsic value with the simplest model, single period model. Suppose that you are thinking of purchasing a company's stock. You expect it to pay a $2 dividend in 1 year. At that time, the expected selling price is $14. With a 20% required return, what is the maximum price that you would be willing to pay? Here, the maximum price is basically the intrinsic value of the stock, which is PV. Gather the information you have. D1, next year dividend, equals $2. P1, the stock price after 1 year, equals $14. CF1, total cash flow for year 1, equals $2 plus $14 equals $16. CF1 is the FV. Using financial calculator, set compounding to annually, FV equals 16, IY equals 20, and equals 1, last step press PV, you will get negative 13.33. This is the maximum price that you would be willing to pay. PV is the intrinsic value, it is also called P0. Let's take another example, multiple period model. For the same company, what if you decide to hold the stock for 3 years? Dividend for year 1, D1, equals $2. Dividend for year 2, D2, equals $2.10. Dividend for year 3, D3, equals $2.21. Price at year 3, P3, equals $15.43. Now how much would you be willing to pay? By using financial calculator, key in discount rate, IY, equals 20%, CF0 equals 0, CF1 equals $2, CF2 equals $2.10, CF3 equals $2.21 plus $15.43, equals $17.64. Last step, press NPV, you will get an answer of $13.33. This is the P0, i.e., the intrinsic value. In fact, there are many methods for stock valuation. Dividend valuation model is the most commonly used method, which can be divided into three main types. First, zero growth model. It is assumed that firm will pay a constant dividend forever. Second, constant growth model. It is assumed that firm will increase the dividend by a constant rate every period. Third, variable growth model, aka Gordon growth model. Dividend growth is not consistent initially, but settles down to constant growth eventually. Other stock valuation methods, such as dividend and earnings approach, price earnings approach, and other price relative approaches, will also be explained in this video. Let's look at the first one, zero growth model. There are a few important points here. It uses present value to value stock. It assumes stock value is the capitalized value of its annual dividends. Future share price is not known or given. The potential capital gains are based upon the future dividends to be received. And it assumes dividends will not grow over time. The formula can be expressed as stock value equals annual dividend over required rate of return. Let's take an example. The most recent common stock dividend of a company was $2.40 per share. Because of its maturity as well as its stable sales and earnings, the firm's management feels that dividends will remain at the current level for the foreseeable future. If the required return is 12%, what will be the value of this company's common stock? For this part, by taking $2.40 over 0.12, you will get $20. This is the value of the stock. If the firm's risk as perceived by market participants suddenly increases, causing the required return to rise to 20%, what will be the common stock value? For this part, by taking $2.40 over 0.20, you will get $12. This is the value of the stock. As the perceived risk increases, the required rate of return also increases, causing the stock price to fall. The next model of dividend valuation model is constant growth model. Similar to zero growth model, it also uses present value to value stock. It also assumes stock value is the capitalized value of its annual dividends. However, constant growth model assumes dividends will grow at a constant rate over time. Do you remember, we just mentioned, zero growth model, the dividend will not grow as it is fixed. Constant growth model works best with established companies with history of steady dividend payments. To calculate the intrinsic value of a stock under constant growth model, we take next year's dividends over required return minus constant growth rate. Mathematically, the formula can be expressed as P0 equals D1 over K minus G. The following is an example for constant growth model. Company A recently paid a $5 dividend. The dividend is expected to grow at 10% per year indefinitely. What would you be willing to pay if your required return on the shares of Company A is 15%? Please take note of the word paid, it is a past tense. So $5 dividend is D0, not D1. But the formula requires us to use D1. To calculate P0, we take $5 times 1.1 to get D1. Over K minus G, that is 0.15 minus 0.1, you will get an answer of $110. This is the intrinsic value. The other one is variable growth model. Same as the previous two models, variable growth model uses present value to value stock. And it also assumes stock value is the capitalized value of its annual dividends. However, the difference of variable growth model is that it allows for variable growth in dividend growth rate. The most difficult aspect of this model is to specify the appropriate growth rate over an extended period of time. By discounting all the future dividends in stock price, you will get the value of the stock, P0, that is the intrinsic value. Let's take an example. Company X last paid dividend was $2.21. We estimate that its dividends should grow by 20% in year 1, by 16% in year 2, and then 13% in year 3, before dropping to an 8% rate. In addition, using CAPM, we estimate that its stock should produce a required return of at least 14%. What's the maximum price that you should be willing to pay for the stock? Maximum price is the intrinsic value, P0. Last paid dividend, this is D0. To get D1, we take $2.21 times 1.2, in which the growth rate is 20%. For D2, we take D1 times 1.16. Whilst for D3, we take D2 times 1.13. Refer back to the question, the last growth rate, 8%, is a constant growth rate. This is used to calculate P3. By taking D3 times 1.08, we will get D4. D4 over K minus G, you will get P3. By using financial calculator, key and discount rate, IY equals 14%, CF0 equals 0, CF1 equals $2.65, CF2 equals $3.08, CF3 equals $3.48 plus $62.50 equals $65.98. Last step, press NPV. NPV equals $49.23. This is the P0, that is the intrinsic value. Although DVM is very useful in estimating the intrinsic value of common stocks, it is subject to some limitations. First, the difficulty of accurate projections for future dividends. It can never be simple to forecast the future dividends, because it is hard to forecast the sales and net profit of the company. DVM assumes that the only value of a stock is the return on investment it provides through dividends, in which the capital gain is ignored. DVM cannot be used to evaluate stocks that don't pay dividends. Calculations are subject to errors that are magnified over time. DVM ignores the effects of stock buybacks, which can make a vast difference in regard to stock value being returned to shareholders. Dividends and earnings approach is very similar to variable growth model of DVM. It uses present value to value stock. And it assumes stock value is the capitalized value of its annual dividends and future sale price. This approach works well with companies which pay little or no dividends. By discounting all the future dividends and stock price, you will get the value of the stock, P0, that is the intrinsic value. Let's take an example. Company A latest dividends of $4 a share are expected to grow to $4.32 next year, to $4.67 the year after that, and to $5.04 in year 3. In addition, the price of the stock is expected to rise from $56.50, its current price, to $77.55 in 3 years. Use the dividend and earnings model and a required return of 15%, find the value of the stock. Using financial calculator, key and discount rate, IY equals 15%, CF0 equals 0, CF1 equals $4.32, CF2 equals $4.67, CF3 equals $5.04 plus $77.55 equals $82.59. Last step, press NPV. NPV equals $61.59. This is the P0, that is the intrinsic value. Another one is the price earnings, PE approach. Future price is based upon the appropriate PE ratio and forecasted EPS. This approach is simple to use and easy to understand. It's widely used in stock valuation. To get the stock value or intrinsic value, we take PE ratio times EPS. Let's take an example. Company A generated an EPS of $2.75 over the last 12 months. The company's earnings are expected to grow by 25% next year, and because there will be no significant change in the number of shares outstanding, EPS should grow at about the same rate. You feel the stock should trade at a PE of around 30 times earnings. Set a value on this stock. By using the formula, take PE ratio, 30, times forecasted EPS, which is $2.75 times 1.25, then you will get an intrinsic value of $103.13. Next, we have price to sales, PS approach. It's similar to PE approach, but substitutes projected sales for earnings. It's useful for companies with no earnings or erratic earnings. To get the stock value or intrinsic value, we take PS ratio times sales per share. Let's look at this example. 2W.com is an online retailer of small kitchen appliances. The firm has been around for a few years and has created a niche market for itself. In fact, it actually turned a profit last year, albeit a fairly small one. After doing some basic research on the company, you have decided to take a closer look. You have collected PS multiples on the following internet retailer stocks. Amazing.com equals 4.5. Cooking.com equals 4.1. Fixtures.com equals 3.8. Find the average PS ratio for these three firms. To get the average PS ratio, we take 4.5 plus 4.1 plus 3.8 over 3, then you will get 4.13. Next part of the question. Given that 2W.com is expected to generate $40 million in sales next year, and will have 10 million outstanding shares. Use the average PS ratio you computed above to put a value on this company's stock. Based on the expected sales and number of outstanding shares. Sales per share can be calculated by taking $40 million over 10 million, you'll get $4 sales per share. By using the formula, take PS ratio times sales per share, 4.13 times $4, then you will get an intrinsic value of $16.52. Price to book value, PBV approach, is another approach that is similar to PE approach, but substitutes book value for earnings. To get the stock value or intrinsic value, we take PBV ratio times book value per share. While for price to cash flow, PCF approach. It is similar to PE approach, but substitutes projected cash flow for earnings. It's widely used by investors. Many consider cash flow to be more accurate than profits to evaluate a stock. To get the stock value or intrinsic value, we take PCF ratio times book value per share. Lastly, preferred stock valuation. The value of a preferred stock is equal to the present value of all future dividends. It can usually be valued like a perpetuity, or the zero dividend growth model. To calculate the value of preferred stock, we take annual dividend over required return. For example, Company A preferred stock pays an 8.25% dividend on a $50 par value. Suppose our required rate of return is 9.5%. What is the value of Company A preferred stock? By using the formula, value of preferred stock equals $50 times 0.0825 over 0.095, you'll get an intrinsic value of $43.42. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.